Hello, everyone. My name is Seok. I'm a professor of Sungmyeong Women's University, Seoul in Korea. It is very nice meeting you, and then I'm here to introduce you Introduction to International Taxation. It is a kind of privilege for me to share knowledges and then experiences with you. But it is a fundamental course, so it might be not that popular and you are not that familiar with this matter. But I try my best to let it very, very simple and then easy to understand. Okay, shall we start? Yes, again, the name of this course is Introduction to International Taxation, and my university, Sungmyeong Women's University, and my name is Joon. Somewhat extraordinarily, I got 2 degrees. One is taxation, PhD in law, and the other one is finance, PhD in business administration. And then I also got a field experience and research experience in both areas. Even though that my main perspective is that multinational enterprises decision makers' viewpoint. So from the basics of business managers' viewpoint, I'd like to let you explain the basics of international taxation. First course is about Introduction to International Taxation. Here you have to remember 1, 2, and 3. 1 is issue 1. When is the right time does international taxation matters? And issue 2, 2 things you have to remember. 2 concepts is very important, even though somewhat similar, but 2 concepts, international tax versus international taxation, is different meaning. And now is the time of international taxation, not the international tax. And third, this is about basic, very important concepts of 3 pillars of international taxation. One is residence, and second one is permanent establishment, and third one is jurisdictions to tax. Okay, issue 1. When does international taxation matters? Let's go to the main definition of business. What is business? The core concepts of business is about the exchange or transfer of goods or services for the price, for profit making. And what is international business? The difference between business and international business lies the concept of international. International business refers all commercial transactions, all international transfers, including sales and investment that take place between 2 or more nations. So the basic concepts between business and international business lies commonly exchange or transfer of goods or services, but the difference is international business means international transaction, international transfer. And next one you have to remember is that 3 modes of international business. Here the concept of mode means how to implement, how to make it real international business. I mean the international transfer of goods or services. There are 3 modes. One is international trade, and second one is international investment, and third one is international finance. Now, let's delete the concepts of international finance, and then why don't you compare the 2 concepts, international trade and international finance. International trade is a transfer of goods or services, whereas international investment is about transfer of capital. What is the capital? The capital is a gathered money for specific purposes. So movement of capital is the main concept of international investment, and there is a junction of international investment and international taxation. As soon as capital movement from one nation to the other happens, that is about time to think about international taxation. International taxation matters when multinational enterprise trigger to set up a plan for international investment, make a new factory, make a new mill, or purchase foreign firms in local country. That is the starting point. Think about the international taxation. Although the quest for a profit is a central focus of international business, people also recognize social responsibility in local countries. Even though when they make an investment international or local market, the reason for that is for profit maximization. But from the perspective of multinational enterprise, they have to think about the social responsibility. Always think about the social responsibility, what kind of contribution you can make to the local countries as well. There are two types of international investment. One is foreign direct investment, and the other one is foreign portfolio investment. Here you have to remember the name of issue one. When does international taxation matters? First you have to remember when the company, multinational enterprise, start to make an international investment, international taxation matters. And out of two types of international investment, international taxation is closely related with the concept of foreign direct investment. Foreign direct investment and foreign portfolio investment, the difference lies here. Capital owner or investor, they got a full controllability over their own capital. They make their decision making by themselves and then purchase goods or purchase buildings, factories by themselves or by their own decision. That is foreign direct investment. But whereas in case of foreign portfolio investment, even though the capital owner or investor put their money aside to the agency, normally speaking, financial institute, and then in place of capital owner, financial institute or financial expert, they operate capital owner's money in the international market. That is for foreign portfolio investment. The point is, when they make a foreign direct investment, they, normally speaking, they try to purchase an asset in a foreign country or local market. Those kind of assets compose a permanent establishment, which is very important. That is the starting point of international taxation matter. The study of international taxation involves understanding how tax systems interact with each other, then cross-border investment occurs, then which country has a power to levy tax on the profit arising from the international business. And when a company engages in cross-border investment, the country in which it is resident may seek to tax profit arising from the overseas country in which investment has been made. Here, you have to remember that two concepts. One is resident country. Here, resident country means home country, whereas the opposite concept is source country. Source country means host country. So this is a taxation terminology. In international taxation, we use resident country instead of home country. We use source country instead of host country. So you have to remember here these two concepts. And next issue is about international tax versus international taxation. Somewhat similar, but it's a very different concept. Then here you have to remember that international taxation is a broader concept. International taxation contains international tax concept. Before starting the comparison of international tax versus international taxation, there are two approaches for the multinational enterprise when they make a decision. One is closed fact approach. Closed fact approach is facts are closed, which means when they make a business decision, they do not care about tax matters. Business manager think tax matter very cumbersome, and then let it go, and then they made their decision excluding tax factors, and then they've done all the business behaviors in local market. And after that, as an ex post business behavior, they put all the business document and then tax report to the tax professional, and then by tax professional to all the tax procedures. That is closed factor approach. Whereas open factor approach, it is somewhat a recent approach. It is a tax planning situation, which means different from closed factor approach, facts are not closed, which means facts are not yet determined. As tax planning, that business managers from the beginning, they consider tax variable as a very important managerial variable. And then when they set up a strategy or a tax planning or a tax schedule, then they think about international tax matters, very important. So as an ex ante business behavior, before doing their business strategy, before doing their business behaviors, they consider tax factors as a kind of very important business decision making. That is open factor approach. From those concepts, international tax and international taxation differ from each other. In case of international tax, it's a legal matter. It is called compliance approach. Compliance. When you say compliance, it means accommodating tax law, and then meet processes meet the requirement of tax law that international tax process is done. That is international tax. Whereas international taxation also contain international tax matter, which means tax law plus one thing you have to add more, that is planning approach, which means open fact approach. So international taxation basically contains international tax, legal approach, plus there is a planning or strategic approach is added. That is international taxation. So international tax, think of the tax variable as a driver of international business, whereas in case of tax, think tax variable as a result of international business. This is the difference between two concepts. International tax regime, whether there is an international tax regime or not, it is a scholar's argument. And then there are two arguments. One is there is no international tax regime, there is no enforceability of international tax. There is negative view, which is developed by David Rosenblum in New York University. According to negative view, there is no existence of tax regime, there is no legal text of international taxation. Whereas the opposite view is positive view. Yes, there is tax regime. Yes, international taxation has its enforceability in the world. There is a positive view, existence of tax regime. There is a legal text such as a OECD guideline, tax treaties, and then let other countries enforceable. Keep the tax regulation internationally. There is positive view. Here is an example. If it is enforceable, what kind of examples can you make in the international taxation? Mexico had to abandon its long tradition of applying formulas in transfer pricing and adopt rules modeled after OECD guideline. Here, the OECD guideline make Mexico change their rules. This is typical examples of enforceability. And South Korea similarly had to change its broad interpretation of what constitutes a permanent establishment under pressure from the OECD. In case of South Korea, they have to change the tax regulation in line with the OECD guideline. It is also positive view of tax regime. And there are other examples. I'd like to skip this. And finally, what kind of, if you have to admit that there is an international tax regime, then what kind of tax law can be applied when they make an international tax decision making? Typical example is multilateral international agreement. It is a tax treaty, and comprehensive bilateral anti-double tax treaties, and limited bilateral double tax treaties, and customary international tax law and general principles of law can be the source of international tax regime. Okay, it is an argument among scholars whether there is a tax regime or not. But now is the time there is a new tax regime such as a BEPS, base erosion and profit shifting. It is a newly launched tax regime. So whether you got the argument of a positive view or a negative view, right now is the time. There is an international tax regime. So we have to know that what kind of tax regime, that OECD BEPS is about. Okay, now this is the main issue of first class. It's about the basic three concepts of international taxation. Okay, from the basic, I'd like to let it explain. Think about the domestic business. In case of domestic business, this is a home market. Here, home means, according to taxation terminology, it is resident country. And here's the resident, multinational enterprise or firm. And their main scope of business is within home market. This is called domestic business stage. So when a company, they focused on the domestic business, there is nothing cumbersome. There is nothing contrasting conflicts of interest happen. Why? Because there is only one tax authority. And tax is levied on tax basis. And domestic tax authority, they got a full power to jurisdiction to tax to residents. And what about this? Even though a firm, they focus on the domestic business, but there might be non-resident. But here, in case of simple case of domestic business, non-residents' performance or non-residents' business behavior is not that big, which means this is trivial. But why don't you think about international business? In case of international business, now the focus, the central business moves cross-bordering from home market to international market. Always, host market means source. This is a taxation terminology. So which means, even though it is a company which means the resident of home market, their central business enlarged into the international market. So part of their business is done in the home market, whereas most of other business happens in international market. In that case, then when they make some kind of profit, then who's got a power to levy tax? It is very difficult. First, home country's tax authority, they got a power to this resident. This is called resident principle. According to residence principle, if a company or a person is classified as resident, tax authority of that resident got a full taxing power over worldwide income. Whereas, think about this part. Home country's resident, they do their business international market, this part. Then this area is not home country tax authorities jurisdiction, but international, other source countries tax authorities jurisdiction. And then source tax authorities jurisdiction, this part, I mean that profit of this also source tax authority, source country's tax authority, they got a power to levy tax on the profit arising from this area. It is called source income principle. Source income principle. So when a company, a resident of home market, and start to international business, expand their scope of business toward the international market, there are two tax regimes. One is domestic tax authority, and the other one is international tax authority. They themselves require their share, fair share as a distribution. They require tax. This is the condition of double taxation. This resident have to pay tax to the resident country's tax authority, and then source income, according to source income principle, they have to pay tax to the host country's tax authority as well. This is the concept of double taxation. Again, there are three pillars, three very important concepts of international taxation. First one is residence, and second one is permanent establishment by way of international investment, foreign direct investment, when they establish factory or branch office or other form of assets in local market, that is classified as a permanent establishment. And third one is jurisdiction to tax. In case of residence principle, when a company is classified as a country's resident, over the worldwide income, that resident tax authority, they got a full power to levy tax, worldwide income taxation to the resident. And the opposite concept is when a company establishes permanent establishment in local market, then source tax authority, they require tax right against the source income taxation. When some kind of income is generated in the source country's market, then those fair share that should be levied by source country's tax authority. And jurisdiction to tax. If international market has diverse and then several international market is involved, then many international tax authorities, they require fair share of their tax as a fair share of their distribution. So in that case, allocation and apportionment of multinational enterprise business in the global value chain of M&A. That is jurisdiction to tax. So this first class, international taxation, is very important in three perspectives. First, if a multinational enterprise is classified as a resident of one country, then those resident country tax authority, they could require multinational enterprise profit worldwide income taxation. But when multinational enterprise, they deeply involved in international business by way of international investment, set up a permanent establishment in the local market, then local tax authority, source income tax authority, they require against the source income also the taxing right, that is permanent establishment concept. And third one is when multinational enterprise expand their business scope internationally, wider and wider, several tax authorities require some portion, some apportionment of taxing right against the multinational enterprise income. So, which means that international taxation becomes intricate and difficult to solve. so there might be some kind of international standard to meet the requirement and then meet the kind of common consensus among global consensus. Okay, this is the part of the first lecture, and then let me see you in the next class.